$5.5 trillion. Gone. Not in a day, not in an hour, in 55 minutes. Pause. Let it land. On January 30th, 2026, gold and silver experienced one of the most violent sell-offs in the history of precious metals. Gold shattered the $5,000 floor. Silver crashed below $100. Investors watched their portfolios crater in real time. But here is the thing. Everything the headlines told you about that crash is only half the story. The other half, the half that actually tells you where gold and silver are going next, is happening in a market most people don't even know exists. Stay with me, because by the end of this video, you are going to understand exactly what happened on January 30th, why it happened, and more importantly, what it means for your money right now. Let's start with what was happening before the crash, because context matters. January 2026 was extraordinary for precious metals. Gold surged roughly 27% in a single month. Silver, already up over 60% year to date, was on fire. These weren't small moves. These were the kinds of gains that only happen when multiple forces align at once. What was driving it? The US dollar was near 4-year lows. Geopolitical tensions in the Middle East were escalating. Central banks, China, Poland, India, were buying gold at a pace of 60 to 70 metric tons every single month. And institutional forecasts from Goldman Sachs, Deutsche Bank, and others had been revised upward again and again. By Thursday, January 29th, gold hit $5,608 per ounce, an all-time record. Silver touched $1,264 per kilogram. The mood was euphoric. Fund managers were telling clients to allocate 10 to 15% of their portfolios to precious metals. The bull market felt unstoppable. Visual news ticker. Trump nominates Kevin Warsh as Fed chair pick. And then, Thursday evening, President Trump nominated Kevin Warsh as his pick for the next chair of the Federal Reserve. Now, if you're not familiar with Warsh, here's why that matters. Warsh was perceived as hawkish, fiscally orthodox, someone who would defend the Fed's independence rather than bend to political pressure for looser monetary policy. For gold, which had been surging on the belief that the dollar was being systematically weakened, this was a direct challenge to the narrative. The dollar surged, and on Friday morning, precious metals paid the price. Visual clock showing 9:30 a.m., red candle forming on gold chart. This is where it gets brutal. Between 9:30 and 10:25 a.m. Eastern Time on January 30th, gold shed approximately $3.2 trillion in market capitalization. Do the math on that. That is $58 billion per minute being erased. Gold dropped from around $5,400 to an intraday low of $4,152. That is a 7% free fall in under an hour. Silver was hit even harder. It dumped more than 12%, breaking through $100 and touching $95 At its worst moment, silver futures were down nearly 15.6% for the session. Pause. Now, a sell-off like this doesn't just happen. There is a mechanism. And understanding that mechanism is critical. Here's how it works. When traders accumulate positions during a rally, they place protective stop-loss orders below their entry points, mostly at round numbers, $5,000 for gold, $100 for silver. These are psychologically significant levels, and that's exactly where traders cluster their stops. When prices breach those levels, the stops trigger automatically. They convert into sell orders. Those sell orders push the price lower, which triggers the next cluster of stops, which creates more selling, which triggers more stops. It is a cascade, and it can accelerate from uncomfortable to catastrophic within minutes. The volume data confirms it. Silver futures volume spiked to 81,000 contracts during the peak selling window, well above recent averages. The CME had also hiked margin requirements to $32,500 per silver contract, which forced leveraged traders to either post more cash or liquidate immediately. Most chose to liquidate. Visual Google Trends screenshot. Disperse sell silver search volume tripling. And here's something that tells you exactly how deep the fear went. Google Trends data showed that searches for sell silver and silver crash spiked threefold on January 30th. That is the signature of mass retail capitulation, not a calm reassessment, not a strategic rebalancing, pure emotional panic. Gold was at $419.52, silver was at $95, and here's the question that changes everything about how you interpret this crash. Could you actually buy silver at $95 that day? Could you walk into a dealer, go online, call your bullion supplier, and purchase physical silver at the price your screen was showing? Stay with me, because the answer to that question is the most important thing I'm going to tell you in this entire video. The answer is no. You could not buy physical silver at $95, not anywhere, not from anyone, and that disconnect between what the screen was showing and what was actually happening in the real world is the most significant story from January 30th, bar none. Let's start with India. India is one of the largest gold-consuming nations on the planet, and on January 30th, the exact day gold futures were crashing, Indian bullion dealers were charging premiums of up to $121 per ounce over official domestic gold prices. $121. That is the highest premium recorded since May 2014. A decade. 1 week earlier, premiums were $112. They jumped to $121 during the crash itself. Think about what that means. Physical buyers in India were willing to pay more for gold on the day it was supposedly collapsing. Not less, more. That is not the behavior of people who believe a bear market has begun. That is the behavior of buyers who see a once-in-a-generation opportunity and are racing to grab metal before someone else does. Now let's look at China. Gold bullion in Shanghai traded at premiums reaching $30 per ounce over the global benchmark spot price on January 30th. The week before, $8. That is a fourfold spike in premiums during a crash. This was happening alongside China's new export licensing requirements, implemented January 1st, 2026, which effectively curtailed 60 to 70% of global refined gold exports. Physical supply chains were already tight, and Chinese buyers were paying a massive premium to secure metal right now. According to Winghung Precious Metals, physical buyers in China viewed the dip as, and I'm quoting their head of trading, temporary noise, not a structural breakdown. And here's where it gets really uncomfortable for anyone who believed the crash was the end of the bull market. Multiple physical dealers confirmed that while spot silver briefly touched $95 on screens, you could not purchase a single ounce of physical silver at that price. Actual transaction prices for 1 ounce coins and 1 kilogram bars range from $105 to $115. The paper market said $95, the physical market said $105 to $115, a $10 to $20 disconnect in real time on the same day. Pause. This is what happens when financial liquidation, leveraged traders exiting positions, briefly drives futures prices below what the physical world is willing to accept. The futures market discovered a lower clearing price through forced selling, but the physical market, where actual metal must change hands, refused to follow. Physical holders did not sell at panic prices. Physical buyers stepped in aggressively to accumulate. The screen showed one thing, reality showed another. And if you want to understand which one matters more for where gold and silver go next, keep watching. Because what's happening inside COMEX warehouses right now makes this disconnect look small. This is the part almost nobody is talking about, and it might be the single most important structural story in precious metals right now. During the first week of January 2026, COMEX warehouses, where silver futures contracts are backed by actual physical metal, experienced a withdrawal of 33.45 million ounces in 7 days. That single week drawdown represented roughly 26% of total registered inventory leaving the system. As of mid-January, registered silver stocks, the metal actually available for delivery against futures contracts, stood at approximately 113 million ounces, down from a peak of around 449 million ounces in prior years. Now here is where the math gets uncomfortable. Open interest in the March 2026 silver futures contract alone represents approximately 528 million ounces of exposure, against only 113 million ounces of registered deliverable silver. The paper exposure in a single contract month is more than 4 times the physical metal available to back it. 4 times. Pause. So what happens if traders actually demand delivery? If even 30% of March contract holders elect to stand for physical delivery, meaning they want actual silver, not a cash settlement, COMEX would need to source 150 to 160 million ounces. That far exceeds what is currently available. January delivery data made this even more urgent. JP Morgan issued delivery notices covering 8.1 million ounces during the inactive January delivery month. And here's the striking part. Open interest actually increased by 1,431 contracts during that same period, despite those deliveries. New buyers were entering to demand physical metal even as existing supply was being drained. Traders were rolling contracts from March back to January and February for immediate delivery rather than waiting. That is the opposite of normal market behavior. It signals urgency. The March contract's first notice day is February 27th. If delivery demand reaches the 70 to 80 million ounce range that analysts are projecting, it could strain or exhaust COMEX's current registered inventory. Precious metals analyst Bill Halter has warned, and this is a direct quote, that if COMEX fails to fulfill its delivery obligations, it will completely destroy the credibility of the existing pricing mechanism and trigger a chain reaction that spreads to gold and credit markets. Pause. Let that sit for a moment. A credibility crisis in the silver futures market, spill over into gold, into credit. February 27th is less than 4 weeks away. This is not speculation. This is a structural math problem that is already in motion. Before we move forward, I want to show you what happens when traders position against a structural supply deficit. In Rajkot, India, one of the country's largest precious metals trading hubs, 44 trading firms became insolvent in January. Combined liabilities approximately $425 million. These firms had built leveraged short positions against silver throughout late 2025 and early 2026. They were confident the rally was overextended. They believed silver would not sustain above 1.25 lakh rupees per kilogram. They were catastrophically wrong. Silver surged past that level and kept climbing, all the way to 410 lakh rupees per kilogram. The gap between their short positions and market prices became unmanageable. An emergency meeting on Saturday night saw all 44 traders acknowledge they could not settle their debts. Some shuttered their businesses entirely. The crisis sent ripple effects through trading networks in Ahmedabad, Indore, and Dubai. Pause. This is not ancient history. This happened this month, and the lesson is clear. In a structurally tight supply environment, betting against precious metals with leverage is not a trade. It is a gamble, and the house always wins. Now let's talk about what happened after the crash, because the recovery tells you more about the direction of this market than the sell-off itself. By 10:25 a.m. on January 30th, less than an hour after the low, aggressive buyers emerged. Gold clawed back over $200 from the intraday lows and closed the session at approximately $5,370, down only 0.85% for the day, despite having touched 4,152 just hours earlier. By weekend trading, gold had recovered further, all the way back to 5,580. Silver closed near $98.66 and bounced to $99.20 by Sunday. Now, if you follow technical analysis at all, you know what this price action is called. It's called a hammer candle, and it is one of the most reliable reversal signals in chart analysis. Here's what it looks like. The candle opens near the top. The price drops dramatically, that long lower wick you see, as sellers push it to extreme lows. But then, before the session closes, buyers overwhelm the sellers and drive the price back up near where it opened. Gold's hammer opened at $5,400, dropped to $4,150, closed at $5,370. Silver's hammer opened at $115, dropped to $95.14, closed at $99,200. On top of the hammer pattern, the relative strength index, or RSI, for both metals plunged into deeply oversold territory. Gold's RSI hit 33.5. Silver's dropped to 29.6, both below 30, both historically strong entry points during bull markets. Pause. Here's the critical distinction I want you to understand. In a genuine bear market reversal, when a trend is actually ending, prices grind lower over days or weeks. You see lower highs, lower lows, a slow, painful deterioration. January 30th looked nothing like that. What you saw was a violent single-session flush, followed by an immediate and powerful recovery. The entire 656 drop in gold was recovered within hours. Historically, this pattern, oversold RSI, hammer candle, V-shaped recovery, does not mark the end of a bull market. It marks a reset within one. But before you conclude that the worst is behind us, there are forces building right now that could make the next leg of this rally significantly more powerful than anything we saw in January. Stay with me. Let's talk about geopolitics. Because the world did not get safer while gold was crashing on January 30th. Tensions between the United States and Iran reached a critical point in late January. Reports indicated a U.S. naval fleet was within striking distance. An open window for potential military action extended through early February. President Trump urged Iran to enter nuclear negotiations. Tehran rejected the demand and warned of retaliation. For gold, geopolitical risk is accelerant. When investors perceive elevated probability of armed conflict, disruption to energy supply chains, regional instability, capital floods into safe haven assets. HSBC noted that trading momentum alone could carry gold to $5,000 and beyond in the first half of 2026, even with elevated volatility. And that was before factoring in any further escalation. The Middle East situation remains fluid as of today. Any military action or breakdown in diplomatic channels would likely reignite the safe haven bid with significant force. Now, separate from geopolitics, there is a buyer in this market that does not care about short-term price swings: central banks. Throughout January, central banks globally maintained a buying pace of 60 to 70 metric tons per month. China, Poland, and India were among the most active. Together, these nations have been consuming nearly 30% of the world's annual gold production. China's central bank has reported more than 18 consecutive months of gold accumulation. 18 months straight. That is not a trade. That is a policy decision at the highest levels of the Chinese government. On the institutional side, gold ETFs added 127,875 ounces in the last pre-crash trading session. Sprott Asset Management doubled its physical silver trust program to $2 billion. These are not retail moves. These are sophisticated institutions positioning for something they believe is coming. And behind all of this, behind the central bank buying, behind the ETF inflows, there is a macro structural shift that is generational in scale. The BRICS alliance, China, India, Russia, Brazil, South Africa, and newer members, is systematically expanding its collective gold holdings. The bloc is targeting approximately 65 to 70% of global gold production under its collective control, through coordinated central bank buying, through the development of gold-backed trade settlement systems. Turkey and Kazakhstan have similarly reshaped their reserve portfolios. Goldman Sachs has specifically cited this de-dollarization trend as one of the structural forces behind its revised gold price forecasts. Pause. This is not a short-term trade. This is a generational restructuring of how the world's largest economies store and transfer wealth, and it is happening whether gold is at $5,600 or $4,950. If you want to know what sophisticated money thinks is coming for gold, don't just watch the spot price. Watch the mining stocks. Barrick Gold recorded a 173% increase in its share price over the 30 days leading up to the crash. 173% in 1 month. Part of that was driven by a strategic pivot toward a dual gold-copper model. Copper now contributing nearly 30% of Barrick's total earnings before interest, taxes, depreciation, and amortization. Newmont reported its 4th consecutive quarter of free cash flow exceeding $1 billion, record dividends, aggressive cost optimization, and the VanEck Junior Gold Miners ETF, GDXJ, outperformed large-cap gold mining peers by roughly 13% throughout January. Junior miners are the most leveraged exposure to gold prices in the public equity markets. When institutional money flows into GDXJ at this scale, it means fund managers believe the gold price is going structurally higher, not just temporarily. The equity market is pricing in a sustained bull market, not a one-off spike. Now let's talk about where gold and silver could actually go from here, and let's do it the right way, not with a single prediction, but with scenarios. Because the honest truth is that no one knows exactly where prices will be in 6 months, but we can look at what the data, the fundamentals, and the institutional consensus are pointing toward. And we can walk through the logic step by step. Base case, the structural drivers remain in place. Central banks keep buying at 60 to 70 tons per month. The dollar stays weak. Geopolitical tensions simmer, but do not escalate dramatically. The March COMEX delivery season creates moderate supply tightness, but not a crisis. In this scenario, gold grinds higher toward the $5,400 to $5,550 range by mid-2026. Silver recovers to $100 to $110. This aligns with forecasts from Goldman Sachs, $5,400 by December, and JP Morgan of $5,550 average for Q4 2026. Bull case. A U.S. government shutdown materializes. Iran tensions escalate into military action. The March COMEX delivery season triggers a genuine supply squeeze. COMEX struggles to fulfill delivery obligations. The dollar weakens further as fiscal dysfunction deepens. In this scenario, gold moves toward $6,000 or beyond. Deutsche Bank's alternative scenario targets $6,900. Societe Generale projects $6,000. Bank of America has a $6,000 short-term target. Independent analyst Ross Norman sees a potential high of $6,400. For silver, Deutsche Bank projects $120 in this environment. BNP Paribas targets $100 as a base with significant upside if the COMEX squeeze materializes. Risk case. Kevin Warsh moves quickly to establish Fed credibility, the dollar stabilizes or strengthens, Iran negotiations succeed, and geopolitical tensions de-escalate. COMEX sources additional inventory, perhaps through international transfers, and the March delivery season passes without crisis. In this scenario, gold could pull back further toward $4,700 to $4,800 before finding a floor. Silver could test $85 to $90. Pause. But here's what's important. Even in the risk case, no major institution, not Goldman Sachs, not Deutsche Bank, not JP Morgan, has called for a sustained collapse below $80 in silver or a return to pre-2025 gold levels. The downside scenarios are corrections within a bull market, not the end of one. The consensus range for gold by year-end 2026 is $5,400 to $6,900. That is the institutional view. After the crash, after Warsh, after everything, it has not changed. Now, I want to spend a moment on what could go wrong, because any analysis that doesn't address the bearish case isn't analysis, it's advocacy. And I'm not here to sell you on gold, I'm here to show you what the data says. First risk, Kevin Warsh moves decisively to defend Fed independence. The dollar stabilizes. The debasement trade, the thesis that the dollar is being systematically weakened, loses its foundation. Gold loses one of its primary drivers. This is a legitimate risk. It was, in fact, the catalyst for the January 30th crash. If Warsh follows through aggressively, dollar strength could create meaningful headwinds for precious metals over the next several months. Second risk, geopolitical de-escalation. If Iran enters nuclear negotiations in good faith, if Middle East tensions ease, the safe haven premium that has been embedded in gold prices would compress quickly. History shows that geopolitical risk premiums can evaporate as fast as they build. If the world gets meaningfully safer, gold loses one of its key supports. Third risk, the COMEX delivery squeeze doesn't materialize. COMEX could source additional inventory through international transfers, warehouse reclassification, or cash settlement agreements with contract holders. If the March delivery season passes without crisis, one of the most significant near-term catalysts disappears. These are real risks. They deserve to be taken seriously, but here's the context. Even if every one of these risks materializes simultaneously, dollar strengthens, geopolitics calm, COMEX finds inventory, the structural buyers are still there. Central banks are still accumulating at 60 to 70 tons per month. BRICS is still de-dollarizing. The supply deficit in silver is still real. The risks could delay the next leg higher. They are unlikely to end the bull market entirely. The question is not whether precious metals will face headwinds. They will. The question is whether those headwinds are temporary obstacles or permanent trend reversals. And based on every structural data point available, the answer leans heavily toward temporary. Here's why the timing of this video matters. The US government shutdown deadline was January 31st, today. Prediction markets put the probability at 67 to 78%. If a shutdown materializes, historical precedent is clear. Capital flows into safe haven assets. Gold and silver benefit. The March COMEX first notice day is February 27th, less than 4 weeks away. The inventory math we walked through earlier, 528 million ounces of exposure against 113 million ounces of deliverable silver, that resolution is coming whether we're ready or not. These are not hypothetical future events. They are calendar dates. They are already approaching. So here's what I want from you. If this analysis was valuable, if you learned something today that you didn't know before this video, then do 3 things. First, subscribe and turn on notifications, because the next 30 days could be among the most consequential in precious metals in years, and you need to be here when it happens. Second, drop your gold price target in the comments. Where do you think gold is going by the end of 2026? I want to see your thinking, and I'll be responding to the most interesting takes personally. Third, share this video with anyone you know who is following the precious metals market. Not because I need the views, because this information matters, and most people are not seeing the full picture. This community is built on serious analysis, not hype, not gambling, real data-driven thinking about where the world's money is moving. Be part of that. January 30th was one of the most violent days in precious metals history, but violence is not the same as destruction. The futures market crashed. The physical market held firm. The premiums exploded. The central banks kept buying. The institutional forecast didn't change. The data didn't change. Only the price changed, temporarily. Markets don't move when everyone is comfortable. They move when reality catches up to what the data has been saying all along. Hold 3 seconds of silence. End.